For the first time in 2 decades, on our models, bonds, equities and cash trade close to their neutral levels. That means that bond yields will fall in line with declining GDP growth, and equities performance will track the performance of corporate earnings. The economic landscape remains quite challenging. Economic growth will get weaker, especially in the US, where we feel that the consumer and corporate spending will be weaker. We also think that inflation will fall, but not enough for central banks to cut rates aggressively. We have a preference for US bonds. We expect bond yields to fall quite significantly there, and we like investment grade bonds, high quality bonds, and also inflation protected bonds. In our view, the dollar is going to get much weaker in 2024. The US economy will disappoint, the Federal Reserve will cut rates, and valuation is still far too high. The yen should be the currency that benefits the most from the decline in the dollar. It's cheap, the Bank of Japan will hike rates, and the Japanese economy will surprise on the upside. Investors will face two main risks in 2024. The first is geopolitical. Countries accounting for more than 50% of global GDP will hold elections. And inflation that we expect to decline may not decline fast enough for the consumers to feel relieved, but also for central banks to cut rates aggressively. Despite the risk, we think that investors should feel quite optimistic for 2024. We expect, for the first time in a long time, equities, bonds and cash to deliver positive returns after inflation.